Tomas, we are back, my friend. You know what that means. Time for a little bit more Tasty Live with this man, Chris Vecchio in the house. Let me explain. Chris, you're going to catch Tom at the perfect time. NASDAQ's down 80. Russell's up 15. You got him in a good mood. Don't blow it. Bingo. It's yours.
Gentlemen, good to see you this Tuesday. I was trying to figure out what to talk about on this birthday edition of Overtime. Well, excuse me, let me explain. And I couldn't help but notice
whose birthday is it? My birthday was Tuesday. It's 12th. What do you mean? When did it? 12th.
Birthday, your birthday? Whose birthday?
Maybe it's mine. I don't know. Who can keep track these days?
America's birthday. This is America. We're celebrating America's birthday. What are we doing?
Happy birthday, Chris. I can't believe you have to share it with my month.
When's your birthday?
All day today.
Today.
Oh, today. Beautiful. Congratulations. Happy birthday.
Thank you.
You're surrounded by sensitive
cancers,
my God,
man.
I mean,
you're like a week apart, separated at birth.
Mm-hmm.
Well, practically. I mean, you could see the resemblance. Maybe actually I'm the son, and it's not actually Nick.
I would be my sixth one that I found. I mean, why not? Family member, not sons.
But I figured, we actually do have some information on the NASDAQ rebalancing now. NASDAQ decided to do this lovely thing where naturally they're going to rebalance the entire index, something that affects the public, so they only release the information to their paying clients. I did get a copy of one of the rebalancing reports, however. I shared that with the team this morning, and there are some interesting changes here. I'm curious about your take and what it means for volatility in the futures product itself. I have my own theory here. But the big mover looks like it's going to be Microsoft losing 294 basis points and NVIDIA losing 298 basis points. So Microsoft's going from a 12.8 to 9.8% weighting, and NVIDIA's dropping from 7.3 to 4.3. Apple's probably the least affected, going from a 12.1% weighting to 11.5%. So first things first here, guys, my at least initial question is, how does this change the volatility of the futures product? We're not going to an equal weighted index, but using QQQ and QQEW as proxies, the NASDAQ that's market cap weighted, and then the equal cap or the equal weighted market cap in QQEW, you see that QQEW actually has lower volatility, lower IV index, and lower IVR than QQQ. So if I'm a trader right now, if I'm holding positions in the NASDAQ, I'm thinking, well, you know what, we actually could see volatility shift and come in a little bit as a result of this rebalancing effort. That seems like a fairly intuitive type of reaction, or at least understanding of the situation, insofar as when you have more diversification, less concentration in a portfolio or tracking fund, you're going to see lower volatility. So I suppose I want to lean on you guys to explain to me, it's my birthday wish for you guys to explain to me this Tuesday, what do these special rebalancings do for you? I can only really remember one in my lifetime that actually was on my radar when I was paying attention to financial markets, and it was 2001. Granted, I was still very young at the time, and it was more of a, hey, this is a project we're doing in school. But this is unique. This is not something that traders deal with. Rebalancings happen every quarter, of course, but special rebalancings, they do not. So gentlemen, explain to me, let you explain to me, how are you guys approaching the rebalancing here now that we have some information out about it?
Well, we're going to have a bagel like we always do on a Tuesday, and we're not going to think about, I mean, like, there's nothing, the whole thing with trading with us is you control the stuff that you can control, and you don't really worry about the stuff that you can't control. So like people when it comes to markets and trading, a lot of people get really, like, in my opinion, a lot of people get freaked out because the news has very few things to focus on. And so they have to bring things like to the forefront to make it sound important or to make themselves sound relevant. But the reality of a rebalancing, and when you say we don't have special rebalancings very often, we don't, but we have rebalancings multiple times a year. And they're not as dramatic, but we do have rebalancing multiple times a year. So for us, and being somebody that's traded index products our entire careers, I honestly don't think that things we can't control are just things that they don't even, like, I haven't thought for 1 second about this rebalancing, and my biggest position is NASDAQ Russell. And so what I was hoping for is that the rebalancing would take some of the steam off the NASDAQ, but I didn't play for it. Like, in other words, I don't know, are you playing for it?
No, I'm not playing for it either, but hoping for not expecting, right? I mean, like Microsoft volatility has expanded because of earnings coming. That would be my news event to it. But I thought it'd be a little bit softer. Now it's down $3 today, but it's just off of all-time highs, or recent highs that it's at. So I mean, I don't think I think anything.
Chris, Nvidia being down 1% today, you cannot look. Nvidia's been up, it's basically doubled or tripled. You can't look at a stock that's down 1% and say, oh, this has any reflection whatsoever on, the NASDAQ.
Today's the day that rebalancing takes into effect.
Most firms, rebalancing is a really simple process if you're in an index fund, because you don't have to do anything. The purpose of announcing the rebalancing is that everybody can load up their in order that you don't get even a 1 penny drag on whatever it is that you want to do. So there's two ways to handle rebalancing as a fund manager. A, you can try to get a jump on things, which means you would sell Nvidia and Microsoft prior to the rebalancing, and then you'd buy some of the other basket, whatever, you buy the whole basket or whatever you want to do, which is relatively easy to do. But the problem with that is you run into a week like what happened now when Nvidia exploded and Microsoft exploded, and then now you're out all these basis points because you tried to get cute. So that usually doesn't work. So the alternative is you just wait. When does this happen? Monday afternoon?
It's going to be next Monday, yeah.
Yeah, Monday afternoon. So Monday on the close, if you put a market on close order in, you're guaranteed the closing price, so there's zero drag to your fund. So it makes no sense. It makes, to me, if I was a fund manager,
unless you got a hunch and you're willing to bet a bunch.
Yeah, the people that had a hunch, they're willing to bet a bunch, already got killed, which is always what happens. It's always some young hotshot fund manager who tries to get a jump on it, sell Nvidia, sell Microsoft, and buy the balance of the basket, and they got killed. Now, everybody else is just going to wait till Monday afternoon and put all the market on close orders in. I think you'll see some very large, sell orders in Microsoft and Nvidia. You'll see some really big buy orders in the rest of the index. I bet it will all pretty much wash out. And I don't know from a trader perspective, because I'm a trader who has a big position on NASDAQ's my single biggest position. There's nothing I can do. Like, I'm not making, there's absolutely nothing I can do. I don't care about the difference in the I don't care about the difference in Nvidia being a little bit lower, Microsoft being lower. Now, if the NASDAQ goes down, today's Tuesday, if the NASDAQ goes down for the rest of the week, people go, oh my God, it's all rebalancing, but it's all crap.
You'd pick a narrative to
I think the bigger, more interesting story that we can probably talk about today is more of we just entered into the next earnings cycle. And at first glance, every single number has been really strong. Relative, and the market's near all-time highs. It's at multi-year highs. Let's leave it there. Not all-time highs, but multi-year highs. So with the market at multi-year highs and the earnings, and earnings stocks so far, have we even had a downtick in any of them?
No.
The move in Schwab this morning is huge. Way outside the expected move to the upside, almost up $8, and everything else. I didn't look at Morgan Stanley. Did you?
It was pennies before, but I can check for you right now. Oh, Morgan Stanley up $4.40.
Yeah. These were.
It opened at 87.5. It's $3 and higher now. It was up.
Yeah, we didn't trade Morgan Stanley. What was the other one that came out last night?
Morgan Stanley, Bank, Schwab, and
Bank of America is a tough one. Even that stock's up $1, which is 3%. I think that the story here so far, Chris, has been that even with the market really strong, these earnings plays have been incredibly rich, which I think is a surprise to most people.
It's a good transition because I do have some information on the earnings for the second quarter thus far, and through Friday, only 6% of companies had reported thus far. 80% of companies were reporting a positive EPS surprise, and 63% were reporting a positive revenue surprise. Interestingly enough, the blended earnings decline is negative 7.1%, which would be the largest earnings decline reported by the index since the second quarter of 2020, and the third quarter in a row which we've seen that. But I wanted to look at this from a historical perspective. FactSet provides great insight and context for some of these data points. They point out that if we look at the last 5 years, we're actually looking at closer to our 5-year average in terms of how earnings are shaking out rather than what we've seen over the past 12 months, over the past 4 quarters. And that's a good thing because the last year has been marked by a decline in earnings and obviously a very difficult environment for stocks, at least when you think about prior to 6 months ago or 7 months ago. And so there's a lot of negativity built into the past year. But to that point, of the 30 companies that have reported earnings thus far, 80% again are above the mean EPS estimate. We're exceeding earnings estimates by 8.8%. These are effectively in line with the 5-year averages, which are about 77% of companies beating the EPS estimate and the earnings growth rate increasing by 7.4% on average. So when we think about it, this means that the actual earnings growth rate for the quarter is starting to turn positive. And that actually means a lot in terms of this bull market that we're seeing unfold right now. You and I, Tom, Tony, and I, we've all previously chided people who are traders commenting on valuation, right? As a trader, PE multiples, they can stay way out of whack longer than perhaps any time frame in which we're operating on. Certainly, when we think about like a 45 DTE cycle, valuations can stay stretched throughout that entire period without a reverberation or snapback. But when we look at how bull markets are born, it typically starts with a multiples expansion. And it typically happens a year before earnings turn around. So when we think about the bottom in the stock market, it comes in October of 2022. What has happened since then? Have earnings gone up? No, not whatsoever. In fact, the entire market rally can be attributed to a multiples expansion. But that's a good thing. That's exactly what you want to see at the beginning part of a bull market. People are becoming more optimistic about the state of the economy down the road, and so they're willing to pay more for those future earnings down the line. We're entering the decision zone. This is like the kill box. I've been watching a lot of Mission Impossible recently, so I have a lot of these terms in my head. But this is like that zone where now it's time to put up or shut up. We've seen the multiple expansion. We're now through 3 quarters of this, 4th quarter, 1st quarter, now 2nd quarter. This 3rd quarter here is where earnings really should start to show more signs of improvement. And so even if there is a little bit of negativity along the way here, I wouldn't really take it to heart. But any sign of positivity, I think the market's going to run with because it is that confirmation bias for what's already been happening since October, which is trending higher. And so for me, when I see these earnings coming out, the fact that they have been strong, that is a very good omen, particularly in context of where we've been over the past year and over the past 5 years. Traders should not be scared of these PE multiples going up. In fact, it could be a harbinger of a much better market here for the next year or two. The bulls could be running with this for a little while.
I'm going to play devil's advocate.
Sure.
Only because that's what makes the show fun.
Absolutely.
And I'm going to say that is the, that I kind of feel like that is a little bit of the masters of the obvious outlook. And that if you were bearish for whatever reason, or you wanted to be cautious, the reason to be cautious right now is that we are no longer riding a wall of worry. The optimism has flipped, and nothing would make more sense to me than the market selling off on good earnings. As the ultimate contrarian inside of me says that it's just not that easy. And some of these run-ups and some of this multiple expansion has been so strong, and yet it's left different groups, in its wake. The Russell has been destroyed relative to the NASDAQ, and the Dow has been destroyed relative to the NASDAQ. The S&Ps are kind of holding their own, and I kind of feel like what we're about to see may be a very important turning point in the psychology of this market, in the sense that this market, people just love to buy the stuff when it looked like crap. When we're talking recession, when we're talking inflation, when we're talking all the bad stuff. And I just think people, just because the nature of just the sheer size and the totality of all the money flow out there are going to sell into strength, not buy it. I feel like it. I don't know if that's going to be the case. I just feel like it's right for it. That's the contrarian point.
Okay, so I'm curious because this is certainly not a perspective I share. Why do you feel like the wall of worry has disappeared?
Because just like, like one of the first stories Banana talked about this morning was Goldman Sachs raised its estimate of, the chances of us not having a recession. Bonds have just rallied, 4 points off their lows. I think that, all the numbers that have come out have been all the numbers that have come out recently have been super strong. All the earnings numbers have been super strong. All the economic numbers have been super strong. I mean, every single stock, you can't even find a stock other than, I have two stocks. I watch a lot of stocks. I have two stocks, Target and Disney, that are in downtrends. I have like 290 stocks that are at or near their highs. When you see that kind of just across the board, optimism and bullishness, just the stocks I follow. My watch list has, probably 300 is too many, maybe 200 underlyings in my watch list total. And every single stock, except for a couple of those, beaten up SPACs, are essentially at or near, multi-year highs.
I'm going to play a different devil's advocate. What's the wall of worry? Volatility's 1550. Every day it goes down.
Yeah.
I don't think there's
Not
a wall of
anymore.
worry. I don't think there's ever been a wall
Well,
of
there
worry.
was for all of 2022.
For 2020, okay. Well, we're 7 months into
I
2023.
understand,
I'm
understand,
a
but
45-day time frame.
I understand. We've gotten to the point. I'm just saying we've gotten to the point of where we've capitulated on price. And I think we've just
I would
got
say
to the
it's more
point.
about being complacent than a wall of worry. That was
so I
going
think
to be my
that
point.
based on where volatility is trading right now at 13.5, we've gotten very complacent. Now, could it stay clustered here for a really long time? And the answer is, of course.
And we have in the past.
But I don't think it's. I just don't like the risk reward at these levels. That's all.
Fair enough. I think the wall of worry still exists. Will the Fed go higher for longer? Will the Black-Seine grain deal in Ukraine, Russia, will that fall apart? Will that push up food prices? Is OPEC going to cut production and boost oil prices once more? What about all these central bank rate hikes? China's reopening. Still a lot of narrative out there right now that's fueling some pockets of the market to hang on to their bearish premonitions. And quite frankly, I think that seeing the situation where implied vols are still coming in above realized vols when you look at the price action at the end of the day shows that people are still fairly clenched up. And so I don't know if the wall of worry is gone just yet. I think there's still more scaling to be done here.
Well, implied vol is always going to be higher than realized vol. 85% of the time, implied vol is always going to be higher. Is going to be higher than realized vol. Not always, but 85%. Just that's the nature of the pricing models. But I think when when you look at volatility where it is right now, you have to, it screams a very complacent environment, and people have become. And the funny thing about it is that people have become very complacent when risk-free rates are actually rich, when they're rich enough to attract money. When risk-free rates were essentially zero, it was hard to attract money into the stock market. When risk-free rates are 5%, the stock market's attracting all the money. It's kind of backwards. And I feel like, people have just, they just don't respect the amount of risk there is in the equity marketplace right now. And they've just blindly, if you're going to invest in equities and risk-free rates are 5%, then you have to think that you're going to get somewhere between, let's call it on the low side 10, on the high side 25% returns on equity investments here. You're already up. What are you up in the NASDAQ this year? Over 40%, right?
Yeah.
So you're up plus 40% in the first half of the year, and you're going to disregard risk-free rates at 5% to go into hoping to make 25% more.
That's right.
For the second half of the year, so you get a 65%. I mean, we're in very frothy, optimistic territory, and I don't like the story here. I mean, risk-free rates at zero, and you're buying equities with implied volatility at 25% a year ago. That's interesting to me. Risk-free rates at 5% with implied volatility at 13%. I'm not interested, and I think that the public's usually wrong.
That's interesting.
So
sure.
I don't like the argument here for that there's of course there's a ton of upside still, but I don't like it because I think the risk reward is completely swung.
I understand that perspective completely. The one thing that I'm keeping my eye on right now is breadth in the index. We've heard so many complaints that it's only the big names leading the way higher.
Well,
Granted, the
you
big
got a
names are
reversal of that today, which is nice.
right, and there's a great indicator. You can look at the number of NASDAQ stocks trading above their 200-day moving average right now. It's currently sitting at a robust, let me just double check that figure here, robust 81.2%. Now, where did we peak in 2021? We peaked around 92% of stocks trading above their 200-day moving average. But when did that peak occur? It occurred in February of 2021. I think all of us think about the stock market topping out for the NASDAQ in November, and then for the S&P, you actually have to wait until the first day of trading in January 2022. So just because we have seen a big push up in breadth doesn't mean that the broader market still can't rally. And quite frankly, even if breadth begins to decline, those big names could hold up the index still. So for me, that will be the number one thing I'm looking for. Once breadth starts to roll over, if the NASDAQ begins to hold up and it's looking top heavy and you see all these concerns remain, hold on, the participation really isn't there. This is something that could go down more from here. But that's a big window. Again, breadth peaked in February 21. We don't see the top end stocks for another 9 months, at least in the NASDAQ.
He's Chris Vecchio. Mr. Vecchio, thank you so much. Great stuff today, as always. And everybody can check you out this afternoon on your birthday.
Got to work on your birthday. So sad. We'll be back in 90 seconds. We got Tasty Live and a market measure next.
What are you doing for the birthday? Where are you guys going to dinner tonight?
Home cooked meal. Wife's making steaks. We're going to grill. She's making a cake.
She's making it. Hold on. Your wife is making steaks at home and making you a cake.
My wife made me I mean, listen, I'm not going wife for wife with you. Yours is probably a little bit younger, but mine has a lot more experience. We'll take it as it may be. Mine made a nice tiramisu for me.
For your birthday, you got a homemade tiramisu.
Well, I'm going to get one. She hasn't made it yet.
Your birthday was on the 12th.
Yeah, well, it's a little delayed. It's a little delayed.
Did she forget?
No, she didn't forget.
So she gave you an IOU for a birthday cake?
It's better than the other IOU she didn't give me. That's what I'm saying right now. I had a choice. I get the cake or this. I went with the cake IOU. Good luck to you, Chris. Don't say a word. We'll be back in 90 seconds. Market measure next. Peace.